Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamental analyzer tool, aka Mr. Valuation. And, I am a value investor, obviously. That's why I have the moniker Mr. Valuation. But, what I want to do in today's video, I want to talk about risk. Because at its core, at its heart and soul, if you will, valuation and being a value investor is all about risk and all about risk control. All right. And, it really comes down to how much risk are you willing to take to earn a rate of return, and how much risk might you take, which could actually destroy your rates of return, and a lot of times inadvertently. Ben Graham, the teacher of Warren Buffett, once famously said that in the long run, the market is a weighing machine. And what he means by that, I want you to think about that. It's a weighing machine. In the long run, it's the weight of the business that matters. And that weight of the business is measured by fundamentals, earnings, cash flows, balance sheets, the strength of its financial statement, et cetera. But in the short run, it's a voting machine. And people vote their dollars, and that drives stock prices up and down. And that's why stock prices are so volatile. My own version of that is that earnings determine market price in the long run. That's critically important because value is all about discounting future cash flows back to the present value. That's one of the core features of being a value investor. So value is about how much money can you make on the investment. And of course, that's going to be directly related, if you just stop and think about it and apply common sense, to how much money the entity that you invest in this case, we're going to be talking about common stocks, is capable of generating for you as an investor. And then how will that money reward you? At what rate will that money reward you? Because there's a big distinction here that I want to make. And I'm going to talk about the difference between a very high quality business, which is what value investors are really looking for. And the reason for that is because we want to be long-term owners of great businesses, quote unquote, bought at attractive valuations. That's the key part of this whole process, because a great business can simultaneously be a very risky and therefore in the long run, a very lousy investment. Okay, because valuation matters, and valuation matters a lot. So what I really want to talk about today is risk and risk control, and why it's so important to you as an investor. I want you to go back and think about, in the long run, the market's a weighing machine. In the short run, it's a voting machine. Or earnings determine market price in the long run, and emotions determine market price in the short run. And the key is earnings are real. It's money. It's tangible. It's fundamental. Emotions are ethereal. They can come and go with the wind. If the wind changes directions, emotions can go from, euphoric to panic, and they can do it in an instant. And we've seen untold cases of that in, stock market history. So I'm going to feature two companies today and primarily talk about them as risk. And I'm going to utilize the FastGraphs Fundamentals Analyzer tool to do that. But I want to say something about FastGraphs. And people make the mistake. FastGraphs is not a market timing tool. It's primarily at its best a risk assessment tool. It basically shows you, relative to the fundamental values of a business, how much risk you would be taking to invest in it, or conversely, how much opportunity you might have if you're looking at the opportunity to buy a great business at a very low valuation or at an attractive valuation. So it's really about risk control. And risk control isn't about timing the market, and it isn't about having perfect timing. The principle that emotions drive the market in the short run is very real. That's a fact. You've seen panics where people sell stocks that shouldn't be sold. And you've also seen euphoric times when the market values, and I think we're in one of those today, where market values get ridiculous high beyond anything that measures common sense or good business judgment or good business sense. And we get these crazy valuations. So what I want to do is I want to try to put that into real good perspective by looking at two of my favorite companies on the planet. But woe is me, they're two companies that I cannot invest in today. And that's, as a value investor, that's very, very frustrating, because these are exactly the kind of businesses that I want to own for the long term. So let's go ahead and look, and let's start with the first one here, and let's start with Nike. All right, now what I want you to look at with this graph, I want you to look at why I say Nike is a great business. Now, keep in mind, COVID kind of interrupted this graph, because if it wasn't for COVID, you can see that Nike's earnings increased year after year after year, and they grew at a very fast 14.26% compound annual rate of growth. That's a very fast growing company. Growth over the next 3 years is expected to be probably average higher than that. In fact, I can show it to you. We're looking at growth being, let me drop one more year off of there. Growth for the next couple of years will probably be in the 20% range. All right, that's, expecting 35% growth for fiscal 2023, which, by the way, ends in May, followed by 17% growth and then 19% growth as a forecast. All right, so Nike has got, really good growth potential, and that's really awesome growth. All right, but here's the rub. All right. I want to talk about earnings yield. I talk about it all the time. Earnings yield represents what your return would be. Let me put it in those words. If the company that you invested in paid you 100% of the profits that they earned. So in the case of Nike, this dark green shaded area represents their profits. If Nike paid you 100% of these profits, your earnings yield today would be 2.26%. And I'll show you how that's calculated here in a moment. In other words, that's all you would be earning. You're investing your capital. And if you owned 100% of the company and they gave you everything they made profit-wise, your return would be 2.26%. Keep in mind, the dividend is only 0.69% currently. Okay, this white line represents the dividend on the graph, and the area below the line represents the payout ratio. So if I look here at Nike, you can see they're paying out about 59% of their, almost 60% of their earnings 2020 and 2021. They're expected to pay out about 30% of their earnings. And the reason the payout ratio got so high here was because the earnings collapsed during COVID. But in normal times, you can see Nike pays out about 25 to 30% of their earnings in shareholders. So that's why the dividend yield is only 0.69. But the earnings yield is 0.26. But how does that work? Let's look at price. Okay, so let's put weekly closing stock prices on the graph. And this is what I'm talking about risk assessment. That 2.25% earnings yield should raise a red flag in your mind to say, man, that's a lot of risk. Because the key of buying a stock at fair value, like Nike was for all of these years here, or close to it, is that you participate in the growth of the business. When you start overpaying for the company, you take the risk of having the stock move back into alignment with fair value at some point, which could absolutely destroy, and devastate your investments. So, nothing here says anything about the quality of the company. It's AA rated, has 48% debt, has a great balance sheet. So, if I look at Nike as a business, forget about stock price, look at it as a business, it's everything that I want a business to give me. I can look at it from a standpoint of things like cash flows. The company's cash flows have grown at almost 12% a year. If I look at free cash flow, what's left over after what it costs to run the business, free cash flow has grown at almost 12% a year, only with the exception, again, of what happened with COVID, which was temporary, 100-year event and isn't something that is normal in Nike's, operations. If I measure them by earnings, which is another form of cash flow, earnings before interest, taxes, depreciation, and amortization, I see how this stock has always traded at around 15 times EBITDA. It currently trades at 32 times EBITDA. Again, the EBITDA yield is only 3%. All right, and that's before they pay taxes and before they take depreciation and so on. And then finally, let's look at sales. This company normally trades at about 2 times sales. That's what this orange line on the graph represents, 2.24 times sales. Currently, the company's trading at 5.5 times sales. That's 100% overvalued, if you will. Okay, now, the point I want to get at all this, if I go back to earnings and I look at forecasts, the company's expected to grow at 16% a year going forward. I want to make a point for you. That's faster than it has historically grown. Of course, they ran into the COVID thing, which, created some issues here for a couple of years. But that's probably doable. I'm fully confident that Nike can grow at that level. But that does not warrant a blended PE ratio of 44.1. That would warrant a blended PE ratio of about 16.17, which would be right here where, what the PE ratio would be. Look at the red line, the second line there in the graph under the date. That's what that PE is. If that happened, Nike would be, amortizing at about a negative 17% a year through 2024. Even going out to 2025, you'd be losing 9% a year. That would potentially turn a, pretty attractive investment into a pretty poor investment over time, but not because anything bad was done by Nike, simply because the company itself, is the market has driven the value. And that's not even Nike's fault. This has nothing to do with Nike. This has everything to do with Nike here. This is all about risk and risk minimization. Now, if I'm looking at Nike and saying, what can I invest in? Well, obviously it's a footwear company. Of course, it's, Michael Jordan and LeBron James, et cetera, et cetera. So those things are all hot, but I can look at a company like VFC Corporation, which is not directly in the footwear business, but it is an apparel and accessories business. It's grown at 9% a year. It's forecast to grow at 20% a year, faster than Nike actually is expected to grow over the next several years. And this would generate, double-digit rates of return. And even though this stock is overvalued, by the way, and I'm showing it to you, it's not overvalued to the extent Nike is, and you can see how the overvaluation has really reverted back to fair value so many times in the past, and how normally in normal times. Now, a lot of discussion people want to have about interest rates. Interest rates drive the blue line on the graph. They do not drive the orange line. The orange line is measuring how much the cash flow of the business is worth to you in terms of dollars and cents that you would earn as an investor. That's what the orange line is about. The blue line on these graphs is, all about maybe how the market's been valuing a stock, but we've seen this kind of stuff happen before. We saw the tech bubble back in 1999 and 2000 where stocks fell 90%. We saw the Nifty 50 era prior to that where you ended up with lost decades in both of those situations. Stock prices can and will get overvalued. Now, this one here is real enigma. I, got to say this is a great company. But this company, like with COVID, was really actually very vulnerable. Their theme parks were shut down completely, and theaters were shut down completely, which are two big, revenue generators. Now, they're doing a lot of streaming and online business, and all that stuff looks to be very, very attractive. But if I look at Walt Disney, the earnings yield's 1.5% based on expectations for a very strong recovery in earnings. Also, this company did everything that theoretically should kill a stock. They completely eliminated their dividend for a time, and they're planning on, reinstating it. They've had earnings collapses, where the earnings fell to virtually nothing, relative to what they historically were earning. Market, just blew it off. And there's some logic to that. But now we've driven this stock up to a crazy valuation. And if I look at this stock and look at it from a standpoint of where it is, it's expected to grow at over 20% a year. But if you valued it at a 20 PE instead of the 67 PE, 66.77 it currently trades at, once again, you would see substantial losses, annualized losses on this stock, or certainly dead money over the next 3 to 5 years, because the earnings yield is less than 2%. And again, I can go through this with every metric, that I can look at. I'll do it very quickly. I look at cash flows. Of course, cash flows have been killed as a result of having to close their theme parks and, their movies not being able to be released, et cetera. I look at their free cash flow. Their free cash flow, got real close to turning negative, but they still did eke out a little bit. But again, they eliminated their dividend for a while. Again, that would be the death knell for most stocks. The market loves Disney, and I can understand why. I look at EBITDA. We had the same issues with EBITDA. We're looking at a very low EBITDA yield. And then finally, let's look at sales. And you can see that this stock has typically traded, again, at about 2.25 times sales, currently trades at over 4 times sales. So it's an extremely overvalued business, but a great business. And it's a business that's probably going to recover. Now, Disney's only BBB plus rated. But let's look at, it's hard to find a direct competitor to Disney, but let's look at a competitor, if you will. Okay, and that would be Comcast, which is cable and satellite, where Disney owns, I believe it's NBC or ABC. These guys own NBC or vice versa. I don't recall off the top of my head. But if you look at Comcast here, you can see that, it's been growing at a very fast rate as well. I've got some negative data there, so it don't compute. Comcast has grown at 20% a year going back to 2006. It's expected to continue to grow at double-digit rates over the next several years. Forecast growth is expected to be about 16%. The earnings yield is about 5.75%, or we'll call it pretty close to 6. But now this is a faster growing company. You can take a slightly lower, I favor 6.5 to 7. You can take 5.5% growth here, 5.75% earnings yield, because earnings are expected to grow so fast going in the future. That's a distinction that is often overlooked. But you're looking at double-digit expectations here, and you've got an A- rated company with less debt that has a stellar dividend record over the last several years. So it comes down to money. If both Disney, for example, and Comcast paid you $1 worth of dividends, you need to understand if you took that to your local convenience store, for example, and tried to buy a pack of gum, they would not give you more change on the Disney's dollars worth of dividends than they do on the Comcast dollars worth of dividends. $1 is $1. If I could buy a stock that's going to generate this kind of earnings growth in the future versus what I have to pay to invest in Disney, if I have this alternative, why would I want to invest in Disney and take all that risk? Now, it's a momentum stock. It's hot. Comcast actually has some short-term momentum as well. But I look at it with cash flows. It's, moderately overvalued based on cash flows. If I look at it with EBITDA, it's moderately overvalued based on EBITDA. If I look at it on a sales basis, it's marginally overvalued on sales, but you can see it's getting close. This one I might be able to buy aggressively, even with a margin of safety, if I'm just willing to be a little bit patient here, if I just get a little break. Where if I'm looking at Disney or, if I'm looking at Nike, those stocks are just so outlandishly valued that I'd be taking a great deal of risk. Now, I'm not timing the market with that statement. I'm simply saying it makes absolutely no sense to look at a company like Disney at these valuations when historically it's always traded at reasonable valuations, or Nike for that matter, and look at them, and I certainly don't want to be buying them now. Warren Buffett talked about this in a recent video I watched, and it's an old adage on Wall Street. It's called the greater fool theory. You foolishly pay more for a stock than it's worth solely on the basis that a fool greater than you is going to come along and pay you more. There are no fundamentals supporting these valuations. Low interest rates don't matter. They might be responsible for some of this higher market value. But again, the higher market value is the same thing as I've been saying throughout this video. That means you're willing to take more risk for a lower rate of return because you're paying more than you should be for the same level of cash flows that you could buy historically at much lower valuations. Fast graphs is one of the greatest risk mitigating tools that I think I've ever seen. Of course, I'm very prejudiced because I invented it. But the point is, that's what fast graphs are really showing you, how much risk you're taking or how much risk should you be willing to take, to lay your money down. There are good investments that you can find out there that are reasonably priced. And I've shown you a couple here today in contrast to Nike and Disney. Nike and Disney are great companies. If you ever get a chance to buy them at fair value, I believe you should jump on it. And once you do, you should be planning to hold them virtually almost forever. They are the forever type stocks, but you don't buy them at these kind of valuations. At least Mr. Valuation says you don't. If you like what you see here, you might want to take a hard consideration of looking into the Fast Graphs Fundamentals Analyzer software tool. It can help you make money in the long run, but what it can really do is protect you from taking on too much risk. I think that's its greatest salvation. What you want to do is you want to invest in a business. You want to invest in a business when you can buy it at an attractive valuation. And therefore, as the business grows, your price grows with it. And then you also get dividends on top of that. That's the essence of fair value. So anyway, I hope you enjoyed this video. I want to thank you all for watching it. Again, I'm not trashing Nike and I'm not trashing Disney. They're great businesses, great companies. The problem is I believe Mr. Market, the emotional side of the market, the voting machine of the market has driven their prices to ridiculous levels to where there is no sound economics underpinning their investment. There's no fundamentals, there's no cash flows, there's no dividends, there's no earnings that can justify those values. I hope you got something out of this video. It's been my pleasure as always. If you liked the video, give me a like, ring the bell. Again, take a trial of Fast Graphs if you would like. I really appreciate y'all, and I'll be talking to you again very soon. Thanks for watching.